How's it going, everyone? It's Sam. I want to talk about the top retirement accounts to make you rich. Now, I'm going to break down 5 of the probably the most well-known accounts here in the United States. Now, I'm not going to go anything that's specific for teachers or specific for saving for your child's tuition or anything like that. These are, like I said, the 5 most well-known and most applicable to most people in the United States. Now, if you're outside the United States, I'd still say that this is valuable because you might have accounts that are similar. They're just called something different in your own country. Just make sure that you do your research. I'm not a tax professional. I'm not a tax advisor. Anything that I can or anything that I do say in this video could be wrong. So, of course, always consult a tax professional. And none of this is investment advice. But we're going to find the best ways to possibly store some of your money and preserve your wealth over time. I realize that this is not the sexiest topic, but it is definitely one of the most important. Now, I do want to thank today's show sponsor, which is Uranium Energy Corp. They have a high analyst upside. You can see here $5, $3.75, $3.50 price targets, and it's $2.44 now. So the thought process behind this company is the fact that the world is turning more green, and one of the best ways to fuel that green initiative is by uranium and by nuclear energy. And this company has a lot of it. They're led by a 40 under 40 ones to watch by Forbes. They have a strong balance sheet, so they are market cap of $567 million. So it's not a small company by any means, but there's still a lot of upside potential. Of course, this is not financial advice. Do your own research. But you can see they have a strong balance sheet with $123 million in cash, equity, and physical holdings. They have a handful of different projects and can produce a lot of uranium every single year. And they have 2.3 million pounds of US warehouse uranium right now. So do your own research. I can't tell you what to buy. All I can tell you is to take a look at this company. Like I said, TipRanks has a pretty high upside rating on it. It's a moderate buy, but it says 105% upside. So always do your own research. But if you want to check out their information, it will be underneath the video. Ticker is UEC. Thank you, and let's get back to it. So the first account that we have to look at today is the 401k. Now, this is one of the best accounts out there. Now, for most people, they will not be maxing out this account. This is something that is offered by your workplace and actually has a relatively high maximum contribution for the year. It's right around $19,000 or $19,500 for the employee, and then the employer can also match part of it. So that is something that draws a lot of people to 401ks in the first place. They're through the employer. A lot of the time, the employers might actually throw some of your salary in there right off the bat. So a lot of the time, they will match a certain percentage, like they might match 100% up until 4% of your salary, or maybe 50% up to 6% of your salary. I've heard some really good plans where they actually contribute like 8% for you, and then you can contribute whatever you want. So there are a lot of different ways that they can set it up, but this is one of the best ways to invest for your future, especially if they give that extra contribution bonus in addition to what you invest. Now, there are a couple different ways that these can be set up. Most of the time, they are taxed. They are pre-tax. So you put money in, it does not count towards your tax for the end of the year. It's actually a tax deduction. And then when you are at the correct age of 59 and a half, then you can start withdrawing it, and that's when you actually get taxed. So if you have it set up that way, it's great. If you're going to make less in the future when you actually are retired, for anyone that's making a decent salary, a really good salary, that's probably the way that you want it set up, because you aren't taxed when you're making more money, and then you will be taxed when you don't need the money as much. So that is a good way to have it set up. Now, how can this actually help you? What are the numbers behind this? We can take a look here at a calculator to show you how much this can actually change throughout time. So let's say you contribute 10% of your salary and you make about $52,000 a year. You are 26 now, you're gonna retire at 56. Annual rate of return is 7%. Let's say the employer matches 100% up to 4%. You would end up having about $509,000 if you didn't get the employer match, but with the employer match, you get $713,000. So that is a huge difference, about a 40% difference. Now from there, if you don't get an employer match, or let's say you don't have another employer, so you have to have something set up yourself, or again, maybe your employer just doesn't offer a 401k or the match. One of the best options for investments here in the US is an HSA account. And let me explain why this is so good for you. So This is one of the only accounts, this is actually the only account in the United States really that you can get away with not having to pay taxes on the front end or the back end. So you get the tax deduction and you don't have to pay taxes for qualified medical expenses. Now, you have to have a high deductible health plan, so make sure you talk with whoever provides this and make sure you talk to your insurance professional or whoever you're getting your health insurance through. But let's say you have, let's say you need contacts or something like that, and you need to pay for them. Well, you can put money into an HSA, just make sure that this is covered. There are rules for HSAs, what is covered and what isn't. But you can put money in there and then it's not taxed on the front end. So instead of being taxed 20%, it's just not taxed. And then you can use it to buy those contacts. And then you don't have to pay tax on it later either. So that is one really interesting way. And I think for most people, they think, oh, I'm not going to have that many medical expenses because personally I'm healthy. But the thing is, I will have a kid one day. I will probably have surgeries one day. There's always some big thing that you're going to have to pay for probably in your life, health related. So if you can actually set aside some money now to pay for those in the future and they're not going to be taxed now or later, and you can also invest in these accounts, so you can take them and invest into stocks. So that is a great way to actually save some money, invest it, and grow it over time, and then use it tax free. The other thing is you can actually pay yourself back at a later date. So let's say I have some big medical procedure, but I know in a couple years, let's say I'm 59 and I know that I want to retire at 59, but I can't start withdrawing from my 401k for a little while. I can store up those medical expenses and then I can go back and pay myself out at that point. So I know that I have to fill a little bit of a gap before I can actually draw from some of my retirement accounts. I can actually take out some of that money then. So that's an awesome way to go about it. Now from there, we have the Roth IRA and the traditional IRA. So these are kind of hand in hand. And the Roth IRA is an individual retirement account. It's a way to invest for yourself. Let's say your employer doesn't offer a 401k, you can start investing yourself and you can contribute up to $6,000 a year. For most people, there's a catch-up contribution when you're a little bit older, but you can invest before taxes. So the great thing about this is you put money in now, you can pay taxes now, and then later on, you don't have to pay taxes. So if you are someone that thinks that they are going to make a lot more money in the future than you're making now, or if you think taxes are going to go up in the future because we have pretty low tax rates right now, then you can invest in a Roth IRA and you've already paid your taxes. So that is a great way to invest for the future, especially if you think, okay, maybe I am in a very low tax bracket, maybe I'm a single parent, or maybe I'm just in kind of a dead-end job, or I'm in a job that leads up into a really high-paying job. It's a great way to invest for your future in a Roth IRA. Now you have to be a little bit more careful here because there are max limits on how much you can make. Most people fall in those limits, but it's something to consider. Then you can go traditional IRA. So this is similar to what most 401ks are, which is you pay taxes later, but you don't have to pay taxes now. So if you think you're making a ton of money right now, let's say you're making $100,000 and you don't think you're going to make that in retirement, then you can pay taxes on it in the future instead of right now. Maybe you want that tax deduction up front. And then we're also going to talk about brokerage accounts. So brokerage accounts are what a lot of people know, like the normal accounts that you set up. If it's not a retirement account through like Webull or M1 Finance or anything like that, it probably is a brokerage account. So that's just a normal account where you are taxed based on your gains and how long you've held it. This is the least tax advantage account really here in the US. So just be careful of this if you are doing the majority of your investing in this as opposed to any of these other forms of investing. It can be good because you might have more control over what you're actually putting in, how much money you're putting in, and then what kind of investments you make, because a lot of the time in 401ks you don't have the control over exactly what you buy. But you have to realize that your gains on this, let's say you hold something for a month and then you sell it and you made 100% gain, you are taxed. If you just hold it for that short amount of time, at least here in the US, you're taxed at short-term capital gains, which means that your profits, the tax rate on your profits are the same as your tax bracket. So let's say you're in the 22% tax bracket, you made 100% gain, that 100% profit is going to be taxed 22%. Now, There are different rules for long-term capital gains, and actually there's some really cool things you can do and not have to pay any taxes on long-term capital gains in brokerage accounts up to about $80,000 for a married couple, which is really cool. But you have to realize you're still paying taxes on the money originally. So even if you invest in a brokerage and you don't have to pay taxes later because of long-term capital gains, you still had to pay taxes originally because you had to have income to put it in there and you weren't given a tax deduction like a traditional IRA or a 401k. So let's go through an example where someone has $15,000 to invest. In this example, we're going to say $15,000 to invest. The person has a $50,000 a year salary, 25 years old, unmarried, no health issues, employer matches 100% up to 4%. Okay, first of all, I would do $2,000 into the 401k because that gives you 100% of the employer match. So that is a great way to go. Always go up until the match if you can, because that is pretty much free money. Even if you have to withdraw it early, and hopefully you don't, but let's say you have to withdraw it early and you have to take all the different tax hits, it's still a great thing to invest because you get 100% return. And even if you get hurt by different rules with taking money out early, it's still going to make you money. So $2,000, you get the 2% or the $2,000 match from the employer. So that's awesome, 100% gain right off the bat. From there, $3,500 into the HSA. I think it's actually 3.55 is the max this year, but $3,500 in an HSA is about the max contribution for an individual. I would definitely do that because, again, that is the best account that we have, assuming you don't get 100% employer match or some kind of employer match. That's the best account. From there, I would put $6,000 into a Roth IRA. So if you're 25 years old and you're making $50,000, you're making a good amount as a young person. So I would definitely think that you might make more in the future, or even if you're able to invest $15,000 now, I'm guessing you will have a lot of investments by the time that you are ready to retire, unless you retire early. But even if you retire early, it still makes sense to invest into a Roth IRA because you can actually take out your contributions, not your profits, but your contributions before the retirement age. From there, you have $3,500 left, and I would put that in a broker. Whether you want to invest in crypto or stocks or anything like that, I would put it into a brokerage account. It does give you some access to it a little bit early, so that is nice because you can take that out whenever you want. So it does give you a little extra liquidity. Now, that is just my opinion. Of course, do your own research. Thank you again to today's show sponsor. Definitely check out the information below on that stock. And I will see you guys in the next video. Let me know what I said wrong and what you would invest in, what account you would invest in instead.